So let's now move to the second paper. Let me introduce Ingomar Krohn. He will present demand-driven risk premia in foreign exchange bond markets. Ingomar is a visiting economist at the BIS and also has previous experience as a senior researcher at the Bank of Canada. Tony Sang will discuss the paper. Tony is a visiting associate professor of finance at Arizona State University. I must say also that I found the paper absorbing and provocative, more so as coming from an emerging market. You can imagine that we have experienced spillovers coming from advanced economies firsthand, and it's becoming more frequent, so certainly it's something to bear in mind. In that spirit, I think the paper very nicely elaborates on the phenomenon of demand-driven risk premia, not so much from the asset pricing classical perspective, CAPM or APT, but rather from a quantity-based asset pricing view. The paper shows how a positive shock in the demand of US Treasuries has an impact of both exchange rate markets and also fixed income markets, mostly by showing a mild depreciation of the US dollar and also a positive effect on advanced economies, fixed income markets. I think one of the very nice things is also that the study shows how the impact depends on the correlation of short-term assets across countries and that of the US. And the paper left me with an unanswered question, an open question, and I will just mention it, is how would the results change under our extreme condition? Somehow my intuition says that there might be a different outcome, that there might be non-linearities or even state dependency, in the sense that when there is a very strong demand for US Treasury securities, maybe what will happen is that the dollar will appreciate and that you will have an increase in interest rates. That's certainly what will happen in an emerging market economy, but you are their expert, and we are eager to hear from you. So please, the floor is yours, and you have 25 minutes.
Excellent. Well, thanks so much for the kind introduction, Gerardo, and obviously to the organizers for including our paper into this wonderful program. This is joint work with Andreas, Uthemann, Rishi, Vala, and Jun Yang, who are all at the Bank of Canada. I'm visiting the BS at the moment, so the disclaimer is a little bit longer than usual. The views are ours, not those of the Bank of Canada's Governing Council, nor those of the Bank for International Settlements. As Gerardo said, I'm going to talk about demand-driven risk premia and foreign exchange and bond markets. And motivating this paper is very simple, and it's particularly after such a nice keynote. So we should care about treasury markets, right? We know that the US outstanding debt, let's use that as a rough measure of supply, has grown substantially over the recent years. Here on this plot, I show you the time series dynamics from the early 90s, and we see that debt has grown from about 3.5 trillion to more than 35 trillion the last year, right? A rough measure of supply. We can obviously look at the flip side of the coin and look at demand by looking at the bid to coverage ratio. So basically the amount that it's bid for at each auction relative to what is supplied. And what you clearly see in the picture here on the right is that moving average, this black line, is clearly above 1. It's actually at around 2.5 on average over the entire sample period, meaning that investors demanded more than 1.5 times that what's actually supplied at these auctions at each and every point in time. So the question we want to ask in this paper is, what happens if demand for these US safe assets is shifting? And since they're anchoring investor portfolios around the world, we are particularly interested in how do shocks transmit internationally via the foreign exchange and global bond markets. And we're trying to take into account explicitly which of these shifts are coming from the demand side. And I'm going to tell you how we identify that. In the paper, we basically have a little theoretical framework that builds of these preferred habitat models. Which basically have constrained intermediaries at the core of their models. I'm only sketching the mechanism in today's presentation, but we have a little toy model in the paper. What I want to spend more time on is basically talking about the identification strategy. And I want to explain to you how we use high-frequency data around treasury auctions to make the point how to extract demand shocks that then eventually spills over into international financial markets. And then I want to show you a couple of pictures with our empirical findings, and I'm going to argue that an increase in treasury demand leads to a foreign currency appreciation. To put it differently, the dollar depreciates, and we see that foreign bond prices go up. That is a common phenomenon in the G10 currencies that we look at, but we're going to argue that the transmission mechanism across these market segments depends heavily on how close the foreign country's monetary policy is co-moving with that of the US. And we're going to measure that by the degree of short rate correlation between the two countries. More broadly, we're going to argue that in the paper we provide an empirical framework that actually helps us to causally identify how demand shocks transmit internationally. And it basically gives us a direct validation of these quantity-driven theories of international risk premia in a combined setting. Okay. A very light slide on the literature. So obviously there has been quite a bit of interest recently in the asset pricing space on demand-driven theories, not only in the international finance literature, but more broadly. Our paper is mostly related to Gorinchas and Greenwood et al.'s paper, and the empirical strategy is similar to what Ray and Gorodnichenko have been doing. You see there's quite a bit of literature on the US dollar and its safe haven properties, and if you look at the years of these papers, you see it's a very active research agenda, and we're contributing to that, obviously. But more broadly speaking, our paper is also contributing to the discussion on the international transmission channels, not only from a monetary policy perspective, but more broadly about the role of US fiscal policy. Okay, let's sketch the mechanism that we have in mind in one slide, very, very simplified. The toy model we have in the paper is basically based on Gorinchas and Greenwood et al. Papers, where we have two players in the market. We have preferred habitat investors. So again, as we heard of earlier, think of your pension fund or your mutual bond fund who has very strong preferences to invest in instruments with specific maturities. And the second type of investors are global arbitrageurs, which absorb shocks in international markets, but obviously have limited risk-bearing capacity. So they cannot absorb these shocks they can only absorb them to a certain degree. The point of the model is that these demand shifts then transmit across asset classes via changes in risk premia, and not immediate by changes in quantities. So what's sort of like the timeline that we have in mind? We're going to have a demand shock, and I'm going to tell you how we're going to estimate that. We have a demand shock which is exogenous for US Treasuries. As a result, arbitrageurs' risk constraints are going to be relaxed. Why is that? Because their interest rate exposure goes down, their risk limits are less binding, the US term premium goes down, and the Treasury prices go up. That's happening in response to the shock in the US, but we see more globally that then these shocks are transmitting to global bond prices, in particular to those that are highly correlated with the US market. So for countries where the short rate correlation is high, we see that the drop in term premium is particularly high as well, and bond prices go up. Since exchange rates are bound by UIP, this shock transmission is not only visible in the bond space, but we're also going to see it in the exchange rate. And we see that across, again, the G10 currencies, foreign currencies appreciate against the US dollar. So this model only has one risk factor, so it's basically duration risk that moves in response to this treasury auction shocks, but it gives us some very nice predictions that we can take to the data. On the one hand, we have a prediction about the foreign exchange market response. Again, we see foreign currencies are going up. We have a prediction about how bond markets should respond. Again, we see bond prices are going up. And we have this cross-sectional prediction that the response depends on short rate correlation. In the paper itself, we're also going to talk a little bit about the state dependence, and I'll show you a couple of pictures of that, but probably I won't have too much time to talk about it. All right, so let's talk about how we identify these demand shocks. We're going to look at US Treasuries, and I'm going to try to promote a little bit why I think these are nice experiments to use them. First of all, if you think of the US trading day, which is supposed to be this timeline here, it's important to notice that the majority of these auctions actually take place at 1 o'clock Eastern time, so at 1 o'clock New York time. We're going to use high-frequency data from US Treasury futures 10 minutes before and 10 minutes after these US Treasury auctions to see what the impact of these auctions are on prices. So similar to a large literature on monetary policy shocks, we're going to use an event study to extract demand shocks from treasuries. What's important is that it works so nicely here because supply at these auctions are actually fixed and they're well known in advance. So in advance of these auctions, the Treasury will tell you how much they're going to issue at a certain point in time. So supply is fixed. We use high-frequency identification within 20 minutes. So investors' expectations about long-run macro fundamentals should not change in these 20 minutes. So the only thing that is actually moving prices is changes in demand, which investors learn about because the Treasury is actually providing information about the coverage ratios shortly after the auctions. So that's the first condition why these Treasury auctions are actually a nice experiment. The second one is that these auctions are actually isolated intraday events, which again are well known in advance. They do not interfere with other intraday events that we have studied extensively in the literature. So macro announcements in the US usually happen at 8:30. Some of them happen on the same day as Treasury auctions, but they generally don't drive the results. FOMC announcements happen at 2, and by construction, there are no FOMC announcements and Treasury auctions happening on the same day, so we don't have to worry about that. And there are a bunch of other events within the day that people have studied, and particularly in the FX literature, that you might think could affect our results, such as the London fix, FX option expiry, or opening and closing of equity markets. But again, as this figure is sort of suggesting, none of that is really interfering with this 20-minute window that we use to identify the shocks. So it seems like a really clean setup to use. In order to do that exercise, rely on quite a bit of high-frequency data. So we look at 20 years. So we started in 2004 and end of last year. The auction data is publicly available. We get that from treasurydirect.gov. The foreign exchange data is from ALSEC Tick History or Refinitiv. We use the G9 currencies, so apologies, we are not looking at emerging markets. We look at the Australian dollar, Canadian dollar, Swiss franc, euro, pound, Japanese yen, Norwegian krona, New Zealand dollar, and Swedish krona, which in aggregate cover about 2/3 to 3/4 of the market. We start with tick-by-tick data and then aggregate that to 5 minutes to alleviate concerns that anything that we find is sort of confounded by market microstructure noise. In the same way, we extract data on Treasury futures prices, which we get from CME. Again, we start off at the tick-by-tick level, aggregated to 5 minutes, and we have different maturities for this Treasury futures that we could use, everything from 2 years to 30 years out. Most of our analysis, in particular what I'm going to show you today, is looking at 10-year futures. In addition to this high-frequency data, we're also going to use daily data on global zero-coupon bonds, which we get from Bloomberg. And they are going to be used in order to estimate the price impact that we want to observe in the bond market. Let me spend a slide on these auctions, a few summary statistics. So first of all, again, these are frequent events. Over our 20-year sample, we have almost 1,400 auctions. If you compare that to your FOMC announcements that are commonly used in the literature over the same sample period, you have only 160 of those. So almost 10 times or 9 times as much for Treasury auctions. A lot is auctioned at each and every event. So on average, it's about 30 billion. The maturity of instruments varies, everything from 2 to 30 years. On average, it's about 10 years. And again, to kind of put numbers to the figure that I showed you in the very beginning, the bid coverage ratio is always larger at 1. So the minimum is 1.22, so even that auction is oversubscribed. But you see that the maximum figure there actually goes up to 4. So demand for auctions is always higher than what is supplied. In the paper itself, we also look a little bit about who is bidding at what point in time. The Treasury gives you a little bit of a split up, distinguishing between direct, indirect bidders, and primary dealers. In today's presentation, I'll largely abstract from the analysis. They also give you a little bit more information about how much has been actually allocated to different dealer types. Again, we do the analysis in the paper. I'm going to skip that today. How do these shocks look like? Well, first of all, it's important to notice that there are more and more Treasury auctions the further we come to the late 2020s. So this looks like equally spaced, but in fact here at the beginning the distance is 3 years, and then you see like from 2016 onwards this is actually almost yearly spaced. So the number of treasury auctions has actually increased significantly over time. You see that if we look at the split up, the largest share of bids are coming actually from primary dealers. Then you have these indirect bidders, and a small bottom part here are direct bidders. Maybe the important thing to notice there is that the share of indirect bidding has been actually going up in recent years. And then if we look at the two shocks, so one is here the dollar portfolio in the foreign exchange space, and then the dollar portfolio in the global bond space. What I mean by that is simply the unconditional average of US dollar denominated returns in both markets. You see that these shocks look exactly like we would expect shocks to look like. They can be sizable at times, but they also look pretty random, right? Which is sort of nice because we don't want any systematic pattern in one direction or the other. Now, if you believe me and take it for granted that these are actually cleanly identifying demand shocks, then we can run simple price impact regression. That's what I want to show you here. So I'm going to show you a table with currency returns on the left-hand side and our demand shock on the right-hand side, and then the second part of the table is going to have the global bond prices on the left-hand side, and then again the same treasury demand shocks on the right-hand side. What do we find? Well, let's focus on the dollar portfolio first. So again, this unconditional average. We see that in response to a 1 standard deviation increase in demand for US safe assets, the foreign currencies appreciate against the US dollar by about 2.3 basis points. Highly significant. If we look at the bond space, we see that foreign bonds appreciate by about 10 basis points. That's a result that's pretty consistent in the cross-section, right? So without spending too much time on the numbers for now, you see that for both markets, we see stars pretty much everywhere. And again, that speaks to the fact that we have about 1,400 of these events, which gives us a lot of statistical powers compared to alternative event studies that have been conducted in the literature. But if we actually start focusing on the cross-section, there are actually quite some interesting pattern there that we're going to explore further in the paper. So let's focus on the FX market first. We see that in response to a 1 standard deviation increase in demand for treasuries, we see a huge impact for the Japanese yen. So there we see the Japanese yen is increasing by 4 basis points, but a relatively muted response for the Canadian dollar, only slightly significant. That's in the FX space. In the bond markets, it seems like it's the opposite, right? The Canadian dollar appreciates, the Canadian bond market shows a very strong appreciation, while the response in the Japanese market, even though it's significant, is way smaller in magnitude. But in total, the table kind of confirms the first two hypotheses of these preferred habitat models, right? Exactly what we want to see. So again, an increase in demand leads to significant responses in both market spaces. But obviously, we can explore this cross-sectional response a little bit more. So again, the left regression we just had is now going to be shown here in the left figure, and then the right equation here is going to be on the right figure. So FX on the left, bonds on the right. And again, a positive beta tells us an appreciation or an increase in bond prices. What do we see? Well, on the x-axis, we put a short rate correlation between the foreign country and the US. So again, a measure of monetary policy integration, if you will. Let's start in the FX side. We see that the response of the Canadian dollar was very, very small. It's only about 0.5 basis points. But on the other hand, we have the Japanese yen, which ends up here around 4 basis points. On the other hand, in the bond market, we see exactly the opposite pattern. So while the Canadian dollar only responded mildly to this demand shocks, we see a very, very high impact in the bond space. But conversely, the Japanese yen responds strongly in the FX space, but only very mildly in the bond space. So we have this cross-sectional dispersion depending on how closely monetary policy is co-moving with each other, right? So the extent to which foreign exchange markets will kind of absorb these shocks depend highly on that. And that's not only limited to these two currencies or countries, but you actually see it very, very nicely in the cross-section of FX, but also of bond markets. And in fact, if you calculate the correlation, you see that you have a correlation coefficient of minus 0.9 in the foreign exchange space, and a correlation of plus 0.9 in the bond space. So this degree of short rate correlation is highly important and sort of confirms hypothesis 3 of these preferred habitat models. Now, we run a bunch of robustness tests in the paper, playing around with the window size. We use alternative data sets where we don't have indicative quotes, but in fact, traded prices, so you don't have to be concerned about stale prices. We use alternative measures and specification of demand shocks. Seasonal effects don't play a role. We also couldn't identify periods that were particularly driving this pattern. It seems to be very strong over the entire 20 years. Another concern that you might have is that maybe there's just like a mechanical relationship between FX and treasury futures or bond prices and treasury futures at this particular point in time. So we run a bootstrap exercise to kind of make the point that auction days are special. Let me be precise. What we're going to do is we take basically all the days when no auction is happening, and we're going to construct the same type of shocks in a 20-minute window around 1 p.m. And then we're going to run placebo regressions between that placebo shock and FX returns, and then basically do that 10,000 times, and we're going to plot the distribution of these shocks over here. This is for the FX market, again, on the left, and on the right for the bond markets. And the takeaway clearly is that on auction days, you have a beta coefficient on the FX space, which is above 2 basis points, while basically on all the other days, there's nothing happening between the in terms of co-movement between FX markets and treasury futures. And you kind of see the same here on the right-hand side. So there's no mechanical relationship between the two on all the other days, or on days in general, that would sort of like drive our results. Another concern you might have is that, well, this is a 20-minute window, so why should I really care about this market microstructure noise? So we're going to run some local projection exercises where we're going to regress the shock that we have basically on cumulative returns following these auctions. And what you're going to see here on the left for FX markets, as well as on the right for bond markets, you see that there's a sizable effect, obviously, on impact, as we've just shown you in the previous tables already. But then you see that this impact is sort of increasing over time, in particular in the FX space, and then slowly dying out between like 2 to 3 weeks afterwards. And again, we interpret this finding sort of in line with these models that in the first place, risk premia are going to adjust, because it takes time for flows to move. And then over time, flows are going to adjust, and risk premia are sort of like moving back to their initial state. Now, let me talk a little bit about the state dependence and the differences how treasuries are perceived over time. So what we're going to do is we're going to kind of replicate this recent high-frequency measure of the stock-bond correlation by basically using high-frequency data on equity futures at the 5-minute frequency and 10-year treasury futures, again at the 5-minute frequency, and then can kind of like calculate this correlation at the daily level, because we're going to have 288 observations each and every day. That gives us enough observation on each and every day to calculate that co-movement, and then we kind of can distinguish between days where treasuries are considered risky and days where treasuries are considered as like safe assets. So days where they co-move in the same direction or where they move in the opposite direction. And we would kind of expect that, you know, the extent to which our demand effect has an impact varies across these days, because again, treasuries are going to be perceived differently on these types of days. So that's exactly what we're going to do, right? We're going to take our main regression that we had before, but now kind of add an additional interaction term here where we interact our demand measure with this high-frequency stock-bond correlation measure that we extract from high-frequency data. And again, you kind of see that the impact is sort of stronger on these days whenever the correlation between the two is positive, and is less strong whenever it's negative. So in the paper, we run a bunch of other additional tests, which I'm going to skip today. So instead of using at high frequency price measures, we actually run the same regressions with quantity measures, so using this bit coverage ratio, and they generally confirm the robustness of our results. We look at these splits that the Treasury is providing publicly as part of their data provision, and that kind of helps us to highlight what kind of bidders or what kind of market participants are particularly strongly driving our results, and it turns out it's in particular these indirect bidders. If we use the information on allocated assets or allocated treasuries that's also provided, we see that the investment funds are relatively more important than all the other market participants. The problem with that data is we cannot really distinguish where these investment funds are located, whether they are foreign or local. And then we do another exercise in the paper where we basically link our results to a convenience yield channel, and we use sign restriction to kind of distinguish between different types of demand shocks, right? So what we're going to do in the paper is we basically have a demand shock that is driven by convenience yield, and we have a demand shock which is driven by this portfolio rebalancing, this preferred habitat kind of approach that we are pushing for. And we kind of see a strong time variation in the importance of these two measures. And the analysis basically suggests that in particular in the more recent times, so post-financial crisis, these preferred habitat demand shocks play a significantly more important role than these convenience yield shock that were particularly important during the global financial crisis and during the early part of our sample. I have a minute left, but let me conclude. So if there's one picture I would like you to take away, is this beautiful cross-sectional figure here, again, where you kind of see how the price impact varies in FX and bond markets depending on the degree of short rate correlation. Again, in the FX space, you see a negative correlation. In the bond space, you see a strong positive correlation conditional on the short rate correlation. Thank you so much.
We will have Tony discussing the paper for 15 minutes.
Cool.
Tony?
Thank you. First off, thanks to the organizers for having me here and letting me read and discuss this very interesting paper. In short, I thought this was pretty great. The paper is quite innovative and also quite mature. So I'll have a few things to say, but first off, great job. Broadly speaking, what are we doing with this paper? Ideally, we want to, in economics, you just want to explain the dynamics of exchange rates and bond yields. That's a big picture here. And there's a couple of different ways of looking at it. There's a really important economic question here. Fundamentally, there's a tie between yields across countries and exchange rates. Everyone has learned about uncovered interest rate parities. It connects these two things together. There's a fundamental relationship in international finance. Additionally, there's a very important policy question. We're looking at demand shocks to treasuries. Well, we've talked many times today about asset purchases or quantitative easing. These tools have now become a pretty important part of central banking toolkits, and we want to know when we buy up treasuries, when we buy up other securities, what is going to be the market impact and how will this transmit both domestically as well as abroad? Now, there's a lot of different ways of thinking about this. Perhaps a more canonical, dynamic general, stochastic general equilibrium models. These DSG models, they don't do necessarily a great job of capturing the dynamic effects of, bond purchases or these asset purchase programs. And so perhaps a more fruitful way forward is to think about different types of models. And here we're thinking about preferred habitat models that rely on constrained financial intermediaries and also investors that prefer specific types of bonds or other securities. And so in this paper, Ingomar provides some really nice evidence for this preferred habitat framework and to really push this agenda forward and think about using these models to evaluate policy as well as the dynamics in exchange rate and bond markets. If I could summarize this in this paper in two pictures, here's the first result. Positive demand shock leads to declining long-term yields and foreign exchange appreciation. This is the last picture that Ingomar left everyone with. The really nice, interesting thing here is, of course, that you see that the magnitude of the effect of these demand shocks on foreign currencies is pretty well explained by the cross-section of the short rate correlations. All right, so the Canadian dollar, where you see here, highly correlated with the US, has a relatively small impact in the FX market. Japan, which has relatively low correlation, suffers a pretty large effect. The second result that Ingomar did not have much time to talk about at the end, but I found very interesting is that the strength of the impact of the demand shock varies quite a bit depending on which days you're looking at. So Ingomar talked a little bit about thinking about risky days versus non-risky safe days. And basically, the idea is that on days that are considered risky, the price impact of the demand shocks gets to be a little bit larger. All right. And so, in general, this paper does provide pretty nice support for this preferred habitat mode of thinking about bond markets and exchange rate markets. The empirical results align pretty well with the theory, in particular with the toy model that Ingomar has in the paper. And the currency betas, the correlations between the short rates are very good at explaining cross-sectional variation in the effects. Moreover, Ingomar is using this new source of shocks, these demand shocks, to try to investigate currency returns and yields. And as macroeconomists, it's always hard to find independent sources of variation when everything's happening at once. And so I always appreciate a paper that tries to study a new source of exogenous variation to see what we can learn from there. This is, as I said, a very mature paper. So, I'm like the third discussant, and then a bunch of thank yous as well. So I think it's more useful here if I try to provide 3 relatively high-level comments. I'm going to talk about the magnitudes. Do they make sense? I'm going to talk about another theory that we have about the connection between exchange rates and bond markets, which is like, how do we think about flight to safety in this framework and in the results? And then finally, I want to talk about time series variation in the strength of the mechanism. There we go. OK. One of the first things I noticed when reading this paper is that the effects, unfortunately, seem a little bit on the smaller side. Why do I say that? A 1 standard deviation increase in treasury demand causes the US dollar to depreciate by about 2 basis points. And foreign bond prices to increase about 10 basis points. And so if you're thinking about a 10-year maturity, this is like a yield effect of like a couple of basis points. And so when I started looking at the regression table, I was like, all right, so why are these effects so small? And it turns out, well, the main reason is because the shocks are so small. All right, we're measuring shocks, these demand shocks, in 20-minute intervals around these treasury auctions. And for the most part, the majority of what's known about these treasury auctions are already known well in advance of the auctions actually happening. It's like pretty well known that the common way that policy is made is that we don't, for the most part, up until modern days, we don't want to surprise financial markets too much. We don't want to cause too much financial market turmoil. And so there's a key assumption that needs to be made here in order to take these results to the next level, which is that you have to believe that these effects that you're measuring in these 20-minute intervals can kind of be projected linearly forward for larger shocks. That's what makes this study useful. We're measuring something pretty precisely in these 20-minute intervals, and then we're going to try and draw conclusions about larger asset purchase programs or quantitative easing that may potentially, that definitely do generate much larger demand shocks. In general, I think it would make the paper a lot stronger in this sense to just do that calculation for us. Instead of telling us, about what the effects are for these like 1 standard deviation shocks, just tell us, what does this imply for quantitative easing? What does it imply for asset purchase programs? Is this weird? I don't necessarily think so. I mean, it's the same problem that we have with monetary policy shocks that we use all the time in academia, where we measure these monetary policy shocks, these changes in interest rate futures around monetary policy actions. They come out to be a couple of basis points each time. And then we have no problem expanding those shocks linearly. So just do the same here. All right, scale it up. There's another, we mentioned this Greenwood paper a couple of times here. Jeremy's in the audience, so I should mention that as well. But the point is that there have been a number of papers in the past that have also summarized the relationship between yields and exchange rates. And it's good to connect back to these other papers and just tell us, do the results that you find make sense? All right, having a brief look again at this Greenwood, Hansen, Stein, Suran paper. Table 1 here summarizes the relationship between yields and exchange rates. Generally, it does make sense that your results do align pretty well, and it would be good to connect back to this kind of stuff. OK, that's my first comment. The second comment I want to talk about is thinking about flight to safety. So flight to safety is not really in this paper. However, we know that the flight to safety phenomenon does occur, and there's like dozens of ways of showing this. Here's one way of showing it. So if you're focused here right now on the left-hand panel, I'm going to do this at low frequencies. So on the y-axis, I have quarterly changes in the broad dollar index, so US dollar against G10 currencies. On the x-axis, I have a measure of global risk where this measure of global risk is basically looking at the call transcripts of large public corporations and seeing how often they talk about being risky or is it a risky time. And so if you focus on the blue and red dots together, that's like the quarterly data up until this year, you see that there tends to be a general positive correlation. If you focus on the red dots in particular, these are the quarters that correspond with crisis periods, global financial crisis, COVID pandemic. You can see a much stronger positive correlation. In other words, what it's saying here is that over time, during quarters in which risk increases, you're going to see dollar appreciate. Okay. On the right-hand panel, what we're showing is that currencies that tend to appreciate during crisis periods that have high betas with this global risk measure, these currencies tend to pay low excess returns over time. Okay. So taking these two pictures together, all this is saying is that this standard risk-based narrative about the relationship between bond yields and currencies, it still does a very good job of explaining cross-section of exchange rates and bond returns over lower frequencies. So the question is, why is it that we haven't seen any of that in the results that Ingomar is showing? And fundamentally, what I want to say about this is that in this paper, there's the way that the demand shocks are constructed. By construction, there is no flight to safety phenomenon. Okay, this is a paper that's about these high frequency demand shocks. Flight to safety does not exist. Why? In these high frequency demand shocks, the only things that get captured are what information is released in these 20-minute intervals. So if you're thinking about COVID, all right, so like on Monday, on like some random Monday, we find out there's a certain number of deaths in one country or another, or on another random Tuesday, you find out that we have maybe we have like developed a vaccine and like things are not as bad as they were originally. These kinds of developments are not going to be in there. They're not being captured in these 20 minutes. During the global financial crisis, you find out that one bank is in trouble. It gets announced on some random Friday afternoon. Those effects are not going to be in there. Okay, those effects will already have been priced in before the demand shocks get estimated. The only things that that really matter for these effects are what's in these 20-minute demand shocks. All right, I think the discussion in this paper should kind of make that point really clear, in the sense that this is a really highly focused study about demand and basically demand alone. Good. And then so because we think about that, this relates now to my third comment, which is that these effects are really about these demand shocks alone. What is being captured in these demand shocks? So the thing that I found interesting here is that when you think about demand and how demand shocks propagate to the rest of the world through this preferred habitat framework, you're really relying on some narrative about constrained financial intermediaries and their demand for bonds and currencies. Well, we know that intermediary constraints vary quite a bit over time. They vary both in terms of, at higher business cycle frequencies, but also they can vary over time because we just placed new regulations on the intermediary sector. Over the course of Ingomar's sample, for example, you had the implementation of Basel III and the like. And so there are many reasons why you see intermediary constraints change. And so I think, when Ingomar has these results that talk about variation in the impact of demand shocks, I suspect what's actually being captured here is that you're capturing what's happening on different days of intermediary constraints. On what's being identified as risky days, those are potentially days in which intermediary constraints are more binding somehow. And as a result, then you see larger price impact from changes in demand. Whereas on safety days, those are perhaps more normal days in which you have perhaps smaller in price impact. So I would kind of try to look into that and see if maybe there's some potential for that story as well. All right. So that's basically all I wanted to say. I think, again, this is a very well-written paper with clear analysis. I like that it introduced a new instrument in the study of these spillovers between FX and bond markets. Not much about flight to safety, but I think there is a lot to explore here. It's a great starting point for even more analysis. For example, thinking about how effects vary over time, and then trying to like blow up the results to talks directly about QE and other asset purchase programs. Thank you.
So let me now open the floor for questions.
Thanks.
Yeah, good work, man.
See if there are any. If not, I will start by echoing some of Tony's comments. I think the paper is very nicely written and very nicely done. Somehow I think that the statistical significance of the exercise is great. When you look at your regressions and when you look at the correlations, I think it looks awesome. And then I would compare that with the economic significance of what Tony raised. Like 2 basis points seems like a fairly small effect. But let me now turn to a specific question. And this is because you are using US Treasury auctions as the primary driver of how spillovers are connected in FX and bond markets. But as you know, US Treasury auctions are taking place more frequently and will be larger in size because of what's happening with the fiscal deficit in the US. You also have, on another aspect, some concerns about the dollar being the safety asset going forward or not. So my question for you is more like a forward-looking question and your intuition on whether you think that US Treasury auctions will remain as an important driver for FX and bond markets going forward, as your analysis suggests that it is today. So I will start with that question.
Right. Well, thanks for the question. So let me respond to the first part. Maybe we can scale that up. Actually, we started playing around with that. So I would still say that 2 basis points is not that small, considering that on a daily basis we can't forecast exchange rates. It's pretty much zero, and having a persistent impact in one direction within 20 minutes, that's quite strong over up to 15 days, is still not tiny. But the point is well taken, obviously. Will that impact persist moving forward? It's obviously hard to predict. Let me say, when we started with that project, we ended in 2022, and we were quite concerned updating the data, and were concerned that the effects were diminishing. And so far, we haven't seen any evidence of that. Also, in terms of demand for treasuries, leaving out a few auctions that happened in 2025, where demand was relatively weak comparatively, demand for these assets afterwards were pretty impaired. So far, there has been not a sign that will change. But
okay, thank you. Let me see if there are any questions. If not, I had a few, so I will take the privilege of the chair. So what indirect and bidder demand coming from reserve managers. So how important do you think is this demand coming from a reserve management? And do the FX and yield spillovers differ between periods of reserve management accumulation vis-a-vis reserve management deaccumulation?
Yeah, that's a nice question. So we haven't looked at that, so I can't give a very precise answer. Let's put it this way. I think the general problem with this indirect bidder classification is that it's very hard to pin down to what extent that is coming from a specific group. So I can't really say whether it's reserve managers, whether it's like foreign institutions, foreign official institutions, or foreign private investors. There has been some work by Michael Fleming, who's kind of like trying to link this indirect bidder group with the amount that was allocated to different investor types. Mm-hmm. And his analysis suggests that it's primarily foreign official institutions and foreign private institutions that seems to be driving indirect bidder demand. But having said that, we also know that post 2009, 2010, the general demand of foreign investors in US Treasury has been declining. Mm-hmm. So yeah, it's hard to pin it down exactly. And again, there's some time variation there to what extent this bidder category is picking up demand from specific groups.
Okay, thank you. Let me see. Yes, please, Jean.
Sorry, just to try to alleviate some of your burden, Gerardo. This is kind of a speculative question, but given that you looked at this over different subsamples, I thought one of you said it implicitly, and Tony I think said it explicitly, this notion that currencies that tend to appreciate in periods of stress typically don't offer particularly high yields. Now, obviously, that can change over time, and it can particularly change in an environment where fiscal positions of countries are changing quite significantly. I'm just wondering, if you noticed that in any of the subsamples you looked at, or if you'd want to take a step further and speculate a little bit. I mean, one currency, if I have to call one out, that I think is interesting is the yen in that respect, where you're obviously seeing it's kind of a chicken and egg question. Are the higher yields a function of the fact that it no longer appreciates in periods of risk aversion, or the opposite? Thank you.
So we haven't looked at individual currencies, I believe, specifically over these periods, but I would probably speculate to say that we know that, for example, the carry trade was particularly weak post-financial crisis. So there we know that the excess returns, in particular on currencies such as the yen, were pretty low compared to the early part of our sample. And that probably has been picking up a little bit over the last couple of years, where the carry trade has become a little bit more profitable compared to the first few years after the global financial crisis. But something to look into a bit more.
Are there any other questions? I don't think so. So I think that we can now call to an end of this discussion. It has been a very good discussion. Thank you to you both. Congratulations on your work. You are very young, talented persons that have raised very important issues. So thank you so much. And let me please conclude with a round of applause.